Welcome to the world of passive income through dividend stocks, a strategy that might just change your financial future. Did you know that over $500 billion in dividends were paid out to investors last year alone? Yet many people overlook dividend stocks as a powerful tool for building wealth. In this series, we're going to dive deep into how you can start investing in dividend stocks to create a steady stream of income without the daily grind. Whether you're a beginner or looking to brush up on your investment strategies, you'll find valuable insights and practical tips that can help you on your journey to financial freedom. We'll uncover the secrets to picking the right dividend stocks, the magic of compounding dividends, and how to navigate the often confusing world of taxes. Plus, we'll explore how to manage risks and strategically build a robust dividend portfolio that withstands the test of time, ready to turn your investments into a reliable income source. Let's get started and unlock the potential of passive income together. Chapter 1. Cash Flow Countdown. Welcome to the world of passive income through dividend stocks, where your money works just as hard as you do, if not harder. Imagine a scenario where instead of you clocking in day after day, your investments generate income for you while you sleep. That's the beauty of dividend stocks. Let's dive in and see how you can start this exciting journey. Dividend stocks are like the golden geese of the investment world. They don't just sit pretty in your portfolio. They lay golden eggs in the form of dividends. Think of dividends as little rewards that companies pay you for holding onto their stocks. And the best part, these payouts typically happen quarterly. Now you might wonder, how significant can these dividends be? Well, consider this. Historically, dividends have contributed about 40% to the overall return of the S&P 500 since the 1930s. That's a hefty chunk. This shows that dividends aren't just small change. They're a major player in your investment growth strategy. But it's not just about picking any stock with a dividend. You want to choose companies that have a track record of not only paying dividends, but also increasing them over time. These are often referred to as dividend aristocrats, companies that have consistently raised their dividends for at least 25 consecutive years. Investing in these companies can be a smart move because they're generally stable and committed to returning value to shareholders. To get started, you don't need a massive amount of money. Many successful dividend investors began with small sums and gradually built their portfolios. The key is consistency and patience. Start small, think big, and let the power of dividends do the heavy lifting over time. Chapter 2. Dividend Dynamos. Picking winners. So how do you pick the winners in the world of dividend stocks? First off, it's crucial to understand that not all dividend stocks are created equal. To sift through the vast ocean of options, you'll need some smart strategies and a bit of savvy. One of the first things to look at is the dividend yield. But here's a pro tip. Don't be swayed by high yields alone. Sometimes a high yield is a red flag that the stock price has fallen due to underlying problems within the company. A sustainable yield, something in the range of 2% to 6%, is generally a good starting point. Next up, check out the payout ratio. This is the percentage of earnings a company pays out as dividends. Ideally, this should be under 60%. It shows that the company earns enough to pay dividends while still reinvesting in its growth, a balance that's crucial for long-term sustainability. Another essential factor is the company's dividend history. Look for those that have not only maintained, but also increased their dividends over the years. This is a sign of financial health and a commitment to shareholders. Companies like Johnson & Johnson and Coca-Cola are famous for their long-standing dividend histories. They've been increasing their dividends for decades, making them prime examples of what to aim for. Lastly, don't ignore the overall health of the company. Strong fundamentals, a solid market position, and a track record of growth are all signs that the company is well managed and capable of sustaining dividends. After all, a dividend is only as reliable as the company that issues it. Chapter 3. The Compounding Catalyst. Have you ever wondered how your wealth could grow exponentially over time without extra effort from you? Welcome to the magic of compounding dividends. This isn't just a strategy, it's a game changer in wealth building. Here's how it works. When you reinvest your dividends, you're essentially using them to buy more shares of the stock. More shares mean more dividends next time. And this cycle continues, building your investment much faster than you might think. It's like rolling a snowball down a snowy hill. It just gets bigger and bigger. Consider this. If you start with an investment that pays a 4% dividend yield and reinvest those dividends, the impact over 20 years can be staggering. You're not just gaining from the initial sum you invested, but also from the dividends that investment earned, and so on. Albert Einstein once called compound interest the eighth wonder of the world, and he wasn't kidding. It's that powerful. To get the most out of compounding, start early and be consistent. The earlier you start, the more time your investments have to grow. Time is your biggest ally here. Even if the market dips over a long period, your portfolio can still come out stronger if you've been consistently reinvesting your dividends. It's also smart to use dividend reinvestment plans, DRIPs. Many companies offer these plans, which automatically reinvest dividends for you, often without any transaction fees and sometimes at a discount to the current stock price. This means you can buy more shares for less money, accelerating the compounding effect. Remember, the goal of using compounding isn't just to increase your wealth. It's to do so in a way that's practically effortless on your part. By setting up a DRIP, you make the compounding process automatic and seamless, ensuring that your investments continue to grow steadily over time. Chapter 4. Navigating the tax maze. When it comes to dividends, it's not just about how much you earn, but also how much you get to keep after taxes. Understanding the tax implications of dividend income can help you retain more of your earnings and optimize your investment strategy. In the US, for example, qualified dividends are taxed at a lower rate than ordinary income. These rates are 0%, 15%, or 20%, depending on your taxable income and filing status. This preferential treatment can make a significant difference in your after-tax return and is something you should take into account when choosing investments. However, not all dividends qualify for these lower rates. Non-qualified dividends are taxed as ordinary income, which can be as high as 37%. Knowing the difference between qualified and non-qualified dividends can save you a lot of money at tax time. Another smart strategy is to hold your dividend-paying stocks in tax-advantaged accounts like an IRA or 401k. These accounts can defer taxes on dividends until you withdraw the money, or in the case of Roth accounts, potentially make your dividends tax-free forever. If you're an international investor, it's crucial to be aware of withholding taxes. Many countries withhold taxes on dividends paid to foreign investors. However, tax treaties between countries can reduce or even eliminate these taxes. It's worth consulting with a tax professional to navigate these complex rules and ensure you're not paying more tax than necessary. Lastly, consider balancing your dividend stocks with growth stocks in your portfolio to manage your overall tax liability. Growth stocks typically appreciate in value without paying dividends, thus deferring taxes until you sell the stock. This strategy can help smooth out your tax obligations over the years. Chapter 5. Risk Radar. Investing in dividend stocks sounds like a sure bet, but let's not forget every investment comes with its risks. Understanding these risks can help you navigate through turbulent markets and make better investment decisions. One of the most common risks is the possibility of a dividend cut. Companies can reduce or eliminate their dividends if they face financial difficulties. This is not just bad news for your income stream. It usually also leads to a drop in the stock's price. To guard against this, diversify your portfolio across different sectors and industries. That way, a setback in one area won't derail your entire income strategy. Market volatility is another factor to consider. Stock prices fluctuate, and during market downturns, even the most stable dividend stocks can see their prices fall. While this doesn't affect the dividend income directly, unless the dividend is cut, it does affect your portfolio's value. A strategy to mitigate this risk is to focus on stocks with a history of stable dividends, as these companies are often more resilient in economic downturns. Interest rate changes can also impact dividend stocks, particularly those in sectors like utilities and real estate, which are sensitive to interest rate swings. When rates rise, the value of dividend stocks often falls, as investors seek higher yields elsewhere. Keeping an eye on economic indicators can help you anticipate such moves and adjust your portfolio accordingly. Lastly, always consider the company's debt levels. High debt can constrain a company's ability to maintain its dividend payments, especially in tough economic times. A company with a manageable level of debt is more likely to sustain its dividends during economic downturns. Remember, managing risk in dividend investing doesn't mean avoiding it altogether. It means understanding where the risks lie and preparing strategies to handle them effectively. Chapter 6. Building your dividend portfolio. Now that you're familiar with the benefits and risks associated with dividend stocks, let's talk about how to build a strong dividend portfolio. The key is not just to collect stocks with high yields, but to construct a portfolio that provides growth, stability, and sustainable income. Start by choosing a mix of high-yield and growth-oriented dividend stocks. High-yield stocks provide immediate income, while growth-oriented dividends offer potential for increased payouts in the future. This balance helps maintain a steady flow of income, while also allowing for capital appreciation. Consider the industry and company size as well. Including a mix of sectors and different size companies can reduce risk and increase the potential for returns. For example, large-cap stocks typically offer stability and moderate growth, while mid-cap stocks might present higher growth opportunities with manageable risks. It's also important to evaluate each stock's dividend history and financial health. Look for companies with a long track record of paying and increasing dividends. These are often referred to as dividend aristocrats or dividend kings, and they can provide a solid foundation for your portfolio. Reassessment is crucial. Regularly review your portfolio to ensure it still aligns with your investment goals and risk tolerance. This may involve selling stocks that no longer meet your criteria, or adjusting your strategy in response to changes in the market or your personal circumstances. Lastly, remember that building a dividend portfolio is a journey, not a sprint. Patience, consistency, and continuous learning are your best tools for achieving long-term success. Stick to your plan, stay informed, and adjust as necessary.